We are going to do something on Greenland, whether they like it or not, because if we don't do it, Russia or China will take over Greenland, and we're not going to have Russia or China as a neighbor. Okay? I would like to make a deal, you know, the easy way, but if we don't do it the easy way, we're going to do it the hard way. And by the way, I'm a fan of Denmark too. I have to tell you, and you know, they've been very nice to me. I'm a big fan, but you know, the fact that they had a boat land there 500 years ago doesn't mean that they own the land. I'm sure we had lots of boats go there also, but we need that, because if you take a look outside of Greenland right now, there are Russian destroyers, there are Chinese destroyers and bigger, there are Russian submarines all over the place. We're not going to have Russia or China occupy Greenland, and that's what they're going to do if we don't. So we're going to be doing something with Greenland, either the nice way or the more difficult way. Please, go ahead, ma'am.
On Greenland, Mr. President, why is it so important to you to own it when you have a military presence there, which you could expand to affect the security?
Because when we own it, we defend it. You don't defend leases the same way. You have to own it. And, you know, with a nation, look at what happened with Obama, with that horrible deal they made with Iran. It was a short-term deal. It was like a 9-year deal. Countries can't make 9-year deals or even 100-year deals. Countries have to have ownership. And you defend ownership, you don't defend leases. And we'll have to defend Greenland. If we don't do it, China or Russia will. It's not going to happen. We are not going to have, and I like China, I like Russia, I love the people of China, I love the people of Russia. I get along very well with President Putin, but I'm very disappointed in him. I get along very well with President Xi. I'm going to go over to China in April, but I don't want them as a neighbor in Greenland. Not going to happen. And by the way, and NATO's got to understand that. I'm all for NATO. I saved NATO. If it weren't for me, you wouldn't have a NATO right now. But we're not going to allow Russia or China to occupy Greenland, and that's what's going to happen if we don't.
In less than a week, President Trump has captured the leader of Venezuela, pushed for a takeover of Greenland, announced plans to remove institutional investors from the housing market, and called for a $1.5 trillion military budget, with some strings attached for the defense companies. Here to break down the feasibility of all of this and what investors need to be watching is Wendy Schiller, a professor of political science at Brown University. Wendy, it's good to see you. Now, we kicked off the week, of course, with the news out of Venezuela, and I was struck by a take from Axios, where they talked about that this is a sort of remaking of the global order, a post-disruption society, they called it. And one that is not sort of a temporary blip, but this is it, right? This is our now status quo. Do you agree with that? And if so, what does that mean for how we should sort of frame these events that I've been talking about?
Julie, I think it's interesting to think about status quo with President Trump, who's not really a status quo kind of guy. It's hard to be a disruptor and then establish some sort of uniform policy. This is a projection of U.S. power. And this is what Trump has been trying to do in different ways across the world, whether it's negotiating peace in the Middle East, whether it's trying to push Russia a little bit more to the table on peace with Ukraine. He wants to be the guy, and he wants the United States to be the country that, you know, gets rid of bad leaders and puts an end to conflicts. So Venezuela fits really nicely in that box, and there's a lot of oil at stake. So there's always a side deal with Trump, and you know he can argue Ukraine has minerals, Venezuela has oil. So to think about this as a sort of predictor policy, I think, is a mistake, because we just don't know what this president will do. But certainly he believes in, if you have power, use it, which ties in, as you talked about, with Greenland and maybe, you know, increasing the defense budget. Congress just passed the defense authorization bill literally a couple of weeks ago. So it's unclear to me what that new vehicle would be to spend more money, but he's now starting to talk about it.
I want to ask about Greenland in particular, and again, this sort of view that if you want something, you just go out and get it. We were watching Polymarket odds, for example, which seems to be like the new thing that we're all taking our cues from. And we are seeing a tick up in the expectations that the U.S. will buy Greenland. It's only at 15%, but that's up pretty considerably from where it was even just a few days ago. What do you think how do you think that situation plays out, and what will it tell us about, again, this sort of approach on the part of Trump?
Well, history can be instructive, even for a president who doesn't always follow, quote unquote, the rules or precedent. The Louisiana Purchase was also a purchase of land. It really solidified our westward expansion. But even Thomas Jefferson needed congressional authority and permission, and the House and Senate voted on that. They voted on the actual expenditure of the money and the treaty. So, signing a treaty to sort of take over or buy Greenland would be one thing, but coming up with the money and using it legally, I think, would be more problematic for the president. So he'd need the House and Senate GOP to say yes. You're already hearing pushback, pretty strong pushback from Senate Republicans that they don't want any part of this. And then, with affordability and consumers worrying about grocery prices and housing, it's hard to explain as a Republican that this is what you're bringing home to the voter in 2026, getting ahead of the midterms.
Well, you would think that Venezuela would be a tough sell on that front as well, and yet the president has gone and done it, Wendy. I mean, how do you think that is going to play in terms of the midterms and feeding into the affordability question?
Well, at the moment, that military operation cost lives in Venezuela, but U.S. service people were not killed. And I think that's the big sort of line that Trump doesn't want to cross. Obviously, no president likes to do that. But voters will say okay to doing something like that if it's a one and done. Plus, there's oil. And even though gas prices are relatively low, and the oil that Venezuela produces doesn't naturally or easily translate into a gasoline, in other words, dropping gasoline prices, at least people can understand, okay, there's some interest there. But Greenland shipping lanes, business practices, that's a much harder and more complicated sell. So I think that's where things get much stickier for the president and the Republicans.
Wendy, there's been a lot of talk about, with the president making this move into Venezuela and whatever else he might do, the implications for leaders around the globe. Will they take their cues from this? Will they be emboldened to make similar moves? I'm curious your take on that question.
Julie, just thinking about the U.S. perspective and what Trump wants to justify, thinking to, Iran, for example, we've been working hard. We took military action. We'd like to see that regime change. Right. So regime change is something that Trump sort of promised he wouldn't get involved in 2024 when he was running. But Republicans and Democrats alike, presidents like to see more friendly leaders. Maduro was not considered a friendly leader. Neither was Chavez in Venezuela. And certainly the Iranian regime is considered a threat. So I think I'm not sure it emboldens other leaders around the world to do something against U.S. interests. I think now it just adds another layer of unpredictability on what will this president do to accomplish regime change for countries he doesn't think do business well with the United States. And he's putting them on notice that he will take action.
Wendy, when you put all of this together, we're speaking to retail investors here at Yahoo Finance. What do you think they need to know as they watch all of these geopolitical events, which have had not much effect on the market, by the way, but what do you think is most important for them to remember as they watch all of this?
I think two things. One is, what's the exit strategy, right? What is the plan? Do you get mired down? If you get mired down, then we get much more complicated politics and it gets expensive. So I think that's the first part. And how does President Trump raise the defense budget, but then say to defense companies, you can't buy back your stock? What are the strings attached with greater support and use of the military for companies that invest in defense contractors? And they're in every congressional district in the country. So that's a widespread effect. So that's what I would look at. The second is, what happens if the Republicans get so weakened going into the summer that it's quite obvious the Democrats will win the House back? What does that mean for regulations? What does that mean for appropriations? What does that mean for Trump's exercise of power unilaterally? These are things to be watching for. So getting involved, one and done, going in, getting what we need and getting out, that seems like it won't create instability. But anything that doesn't have a clear exit strategy, going into Cuba, going into Colombia, anything else that's been, mentioned on the table, that should start to worry people because it becomes less mobile in terms of the United States' position to get out without incurring too much damage.
And Wendy, finally, I got to ask you about this upcoming tariff ruling that's expected from SCOTUS. Or from the Supreme Court, excuse me, could happen as soon as tomorrow. What are your expectations around that?
The Supreme Court is very difficult to read. We sort of got the younger cohort, right? We've got Kavanaugh, we've got Coney Barrett, we have Gorsuch. It's unclear what they'll do. It seems as though from the oral arguments, they did not think the president was using the right instrument to impose these sweeping tariffs without congressional action. And certainly it is constitutionally Congress's job to control our tariff policy for the most part. But the Trump administration has been rolling back some of these tariffs. Even pasta from Italy, for example, they just sort of backed off on a major tariff there. They've been slowly kind of mitigating or rolling them back. I think a little bit in anticipation of getting a ruling that says you need to find a new vehicle or justification for your actions, and the fact that people are starting to believe that tariffs have an impact on the prices of things that they're buying. So I think the Trump administration is adjusting, and they will continue to adjust no matter what that court ruling is.
Yeah, tariffs are probably not going anywhere, in other words, or at least even if they change a little bit, they're not disappearing. Wendy, good to see you. Thank you so much.
My pleasure.
Big oil executives are at the White House meeting with President Trump to discuss Venezuela's oil reserves following the capture of President Nicolas Maduro.
30 million barrels. I can't even, is that a correct number? 30 million barrels. You hear that, Peter? Of oil was given to us by Venezuela. That's a lot of oil. It's about $4 billion worth, and it's on its way to the United States right now. We're going to be working with Venezuela. We're going to be making the decision as to which oil companies are going to go in, that we're going to allow to go in. We're going to cut a deal with the companies. We'll probably do that today or very shortly thereafter.
Here with more on this meeting, we got Yahoo Finance reporter Jake Conley. Jake, what do we know so far? What did we learn?
Yeah, big meeting today. You've got close to 20 oil executives from the U.S. in the room with Trump. He says, and I'm going to quote this, we're going to be making the decision as to which oil companies are going in, and we're going to be able to allow to go in, and we're going to cut a deal with those companies. We'll probably do that today or very shortly thereafter. So Trump wants to see some of these deals for these companies, Exxon, Chevron, ConocoPhillips, some of the biggest operators in the U.S. He wants them in Venezuela right away. He says also these companies will be, quote, spending at least $100 billion of their own money. So not only does he want them in fast, he wants to see big spending from these companies to the tune of $100 billion.
So that's what Trump wants. But let's say you're one of these majors. I mean, you're Exxon, you're Conoco. What do you need to see before you're comfortable investing aggressively back in Venezuela?
There's a lot of things you're going to want to see. A, you're going to want to see security.
Yeah.
Plain and simple, right? You're going to want to know that not only are your people and your equipment going to be safe, but if you're spending $20, $30 billion, you're going to want a contract. You're going to want to know that contract is going to be honored if something goes wrong. You've also got to remember, oil companies think on decades-long timelines. They do not invest on this month of this year. They invest on 15, 20 years from now. Trump is only going to be president for 3 more years. So these companies are going to have to sit here and say, do we see stability, money, cash flow coming fast enough to justify spending $20 billion to get in on something that, if it's a good investment, we should be in for 30 years.
Well, we mentioned Exxon, we talked Conoco. What about Chevron? What's their role specifically?
Chevron's got the most interesting position here, right? Mike Wirth's company has been there the entire time. When Venezuela nationalized that industry, all other U.S. operators actually left the country. Chevron has been the only operator there operating under a carve-out from the U.S. Treasury Department. They've been the largest exporter of Venezuelan barrels pretty much that entire time. So Mike Wirth's company has resources, they've got people, they've got equipment on the ground. Who can tell how much money they're going to want to put behind this and whether they're going to want to start really ramping up their exports right away? There's a lot of questions around that, but they are certainly in pole position for this play.
Let me ask you, I'll get you on this straight. If you look big picture and you're sort of looking out 12, 24 months from now, what are the chances, the odds, or you actually do see, a significant ramp in oil supply out of there? And what would be the variables that depends on?
I think that would be really fast to see a significant upkeep. Right now, Venezuela is exporting around 1 million barrels a day, a little bit less than that. I've talked to some analysts over the last few days who have said, you might see 1.5 million over the next 12, 24 months if everything goes right. But everything has to go right. There has to be security. The industry has to clean up. You got to remember, a lot of this equipment has fallen apart in the Chavez and Maduro days, so you need quick infrastructure investment. Getting back up to 3 million barrels a day, where Venezuela once was, Rystad Energy has said that's going to take more than $100 billion, and it could take 5, 10, 15 years. It could take a long time.
All right, big story. Thank you, Jake. Appreciate it.
Thanks, Josh.
The Supreme Court is not releasing a ruling on President Trump's tariffs today as the court still weighs the legality of the duties. Here to discuss this and much more is Eurasia Group founder and president Ian Bremmer. And Ian, I know this week you were also out with your top risks for this year. We're going to get to that in a moment, but had to ask you about this first. What do you make? We were all sort of waiting for it to happen today, this ruling potentially to be handled down. Looks like we're going to have to wait a little bit longer. But how should we be thinking about what the Supreme Court may say, considering the administration seems well prepared for it?
Well, it is likely to be one of many constraints on Trump's ability to continue to use tariffs as his principal tool to project American power around the world. Another is the fact that the Chinese in particular have shown that they're prepared to hit the Americans back hard, and therefore Trump is tilting more towards trying to get to a deal, to get to yes to Xi, as opposed to forcing him to capitulate. You've got affordability issues driving political discontent with President Trump now, as opposed to being one of the top positives when he first became president for his second term a year ago, and the likely eventual ruling from the Supreme Court to constrain, at least in part, President Trump's tariff-making capacity using IEEPA to determine national emergency. You can't really, no jurist would make that sweeping claim in the way that Trump ask forgiveness, not permission, did originally. And so all of these things imply the U.S. is going to have more constraints on those activities going forward.
You know, it's interesting, and I had a discussion with some market participants earlier who said, that even if some of the tariffs are removed, that the market's kind of priced it in already and adjusted. But on a company-by-company level, if there is more volatility to come on their operations, one would think that would have to, cause some hiccups, at least on that front.
Certainly, uncertainty is the biggest problem. They'd rather a lousy but stable operating environment than one that is all over the map that they continually have to reassess and replan for. But here we're talking, if it turns out, again, as we expect, that there will be constraints, it's very clear what the alternative tools would be for President Trump to impose tariffs, Section 232, others, and that, I think, limits the scale of uncertainty going forward, even though the initial reaction to the Supreme Court ruling will require big readjustments.
And all of this, of course, speaks to the risks that you just outlined this week in your annual list of top risks on a geopolitical basis. The number one risk is U.S. political revolution. What you said you referred to last year about as the rule of dawn. People are now throwing around the term Monroe Doctrine in the wake of Venezuela. And what's interesting is how curiously unaffected since Liberation Day, largely, the markets have been by all of this. What would change that, Ian?
These are long-term concerns for the markets, not short-term concerns. The fact is we have lots of conflict, for example, in areas that produce oil, but demand is relatively soft, and OPEC has about 2 million barrels off the market right now. So, it's fairly obvious that the bigger concerns of the United States saying we're going to change the political system internally and we're going to change the foreign policy operating principles externally, that President Trump said the only constraint on his action is his personal morality. I suspect a lot of allies of the United States do not see that as a significant constraint. Those things are going to have very big long-term impacts in not only how the world is ordered, but all capital moves, how supply chains are formed. And definitely if you are a big multinational corporation investing for 10 years and longer, a time frame which is considerably longer than Trump is going to be president, these things are massively uncertain and they are affecting your decisions. But we shouldn't see that have an impact on short-term investments in the markets.
Yes, and we've talked about this theme before, certainly, as well. I am curious, as we see this remaking, what does it say about the soundness of the U.S. democracy at this point? because of some of the changes that President Trump has made, from influence on the media in some cases to public ownership of individual companies, for example, as well. So what does it mean about the character of our democracy?
The politicization of the Department of Justice and the FBI, to be loyal to him as opposed to independently carrying out the rule of law. These all show that both norms and actual checks and balances that are codified in institutions on the president are weaker than they used to be. And Trump is a symptom of that, but he is also an accelerant of that process. That's what the political revolution is. So we know it's underway, and in many ways we compared Trump to FDR, the other major revolutionary president in history. And in many ways, in Trump's first year, he's showing he's much more willing and capable to break these norms and checks and balances than FDR was over his 3 terms. So that's quite something. But ultimately, we do think that President Trump is likely to fail. Our confidence level is less strong than you would like it to be, but for 3 reasons, in ascending order of importance. First, because Trump is less popular than he was a year ago, and he's likely to lose the House in the midterms, and that is likely to have at least some impact on Republicans thinking he's a lame duck and starting to break away from him. We haven't seen that yet, but it is more likely over time. More importantly, there still are checks and balances on the president. You already asked about the Supreme Court, but we've seen court rulings, for example, stop Trump from his investigations that are politicized into Comey and Letitia James, prevent him from sending the National Guard to Chicago, for example. You still have a professionalized military that reports ultimately to the Constitution. And you also have a federal system of governors and states that run a lot of things in policy, including elections, and that matters. But the most important reason why the political revolution is likely to fail is because Trump is undisciplined. Because even though he says that the Democrats are his principal enemy and the adversary of the United States, and not the Russians, and not the Venezuelans, and not the Iranians, he is easily distracted. He is very impulsive, and he doesn't have a lot of policy expertise. So he's very willing to faff around in Greenland, where a disciplined president that wanted a political revolution, that believed that Biden had actually weaponized the system against him and was a mortal threat, would be spending all of his time and influence on power on destroying that other party and making sure that they have no chance to effectively run for leadership again. They'd be focused on shutting down the fundraising and shutting down the media and all of the things that one does if one wants to actually take control of the reins of the state. And Trump has really shown that even though he has that impulse, it competes with many other impulses. And so ultimately, as they say, sometimes it's better to be lucky than smart, and I do think that the United States falls increasingly in that category.
Ian, we could talk about that for the rest of the hour alone, but I do want to move to one of the other risks that you talk about, and it's the U.S. versus China, not necessarily on the tech front, which is what a lot of people talk about, but on the energy to power the tech front, which I thought was really interesting. You paint the U.S. as a sort of petrostate at this point, and certainly the Trump administration has leaned more into that, and China more depending on alternative sources of energy. I was struck this morning by Meta's announcement that it is partnering with a number of nuclear companies to buy power from them. So how do you see this playing out? Because it's obviously not clear, we're not just relying on petroleum here in the U.S., they're not just relying on alternative sources in China. So how does that all play out?
Yeah, of course, China today is the largest fossil fuel user still in the world. So, there's no question the demand is there. Texas still is the largest producer in the United States, not just of fossil fuels, but also of post-carbon energy. But the United States government has decided that solar and wind is woke. And so, therefore, they don't want to lean into it. They want to take away government support, and they want to lean into improving the regulatory environment for oil and gas and coal. And certainly you're seeing 13.5 million barrels a day, for the United States. That's the largest production of any country in the world. And the fact that the Americans now intend to take over Venezuela with the largest proven oil reserves in the world, while China is doing everything they can to build the wind, the solar, the nuclear at scale, the batteries to store and transfer that power, and the infrastructure and the supply chain globally behind it. And ultimately, that's a 21st century system of energy, which is getting much cheaper with scale in a way that oil, gas, and coal are not. And China's exporting that infrastructure all over the world. So Trump can talk about the Donroe Doctrine, and America has military dominance in the Western Hemisphere, but actually China has stronger economic relations with almost every country in the Western Hemisphere, and they are betting much more heavily that they'll be more successful at it because they're going to be able to export 21st century infrastructure and likely the technology that runs on it. So that long term is a very smart bet for the Chinese and a rather short-term bet for the Americans.
Does it matter, Ian, or how much of a disadvantage is it that, at least for now, the U.S. still has the lead technologically itself, when it comes to chips, for example?
I think it matters less if the Americans are going to have a hard time scaling it, not only because the energy will eventually be more expensive in the United States, but also because those energy demands will compete between technology companies and farmers and consumers, voters. And I do think that in 2028, you're going to see political movements in the United States that are going to be very unhappy with a lot of the technology companies because they see affordability as a growing crisis, and electricity will be a component of that. You saw some of that in the New Jersey special elections for governor just over the past months, but that's just the beginning of this story.
And one of the other risks that you talk about, and this is kind of related to some extent with that, one of your risks, you say AI eats its users. Basically that it will be more of a destructive force than a productive force. What would that look like? How would that play out?
We do believe it's going to be a productive force. These are top risks we're focusing on, so we don't focus as much on all of the revolutionary positive potential of AI that is happening every day. And when you look at the industrial uses, the biotech, the medical uses, when you look at the national security uses, AI is really revolutionary. But here we're talking about the consumer uses, specifically that as these companies spending such extraordinary amounts of money are going to be squeezed by their investors to start turning a profit. And commercializing AI bots for consumer use means experimenting on the population real time to ensure that you get their data and that you get their engagement. And that's a really dangerous thing to do. We wouldn't do that with vaccines, even during a pandemic. We test them first to make sure they're safe. We wouldn't do that with GMO foods, even though people are starving around the world. You test them first to make it safe. But yet when we talk about AI and algorithms and chatbots, we actually test them on our citizens real time. And when that gets motivated by an urgent profit impulse, it becomes very dangerous for society and very dangerous for our politics.
Ian, we're seeing an example of that right now. Grok has been criticized for, sort of opening the floodgates of sexualized images, for example, AI created images, and has reportedly taken some steps to try to walk that back. Do you think that that there will be any regulation of these kinds of activities?
That's right. Test it first, real time on the population, and then walk it back after. And that is unique in our environment because there's no regulatory environment around it. Again, it's kind of astonishing that you let the kids engage with it. You let any adults. I mean, when you think about, we have people in society today that engage with you only to accomplish their purposes with no affect whatsoever, with indifference as to what it does to you, as long as they are making you happy to ensure that engagement occurs. We call them sociopaths. right? And we do everything possible to keep ourselves and keep our children free of them. And yet, that's precisely the way these AI bots are programmed in dealing with citizens. And we are waiting until the damage is done to say, oh, we may need to reprogram that. And it's the companies that are responsible for taking that decision themselves. There's no regulatory oversight. And in Europe, which had been trying to do the most, because they don't have the growth, the productivity, or the tech companies at scale, they're increasingly aligning with the American model, the Wild West, not the Americans saying we need to learn more from the Europeans in thinking about safety of the population.
Ian, it's always great to talk to you, if a little depressing.
Oh, it's not. I know you do. Okay.
Appreciate it, Ian. Thank you. Well, Trump headline risk returning to kick off 2026 with the president's announcements on defense and housing rattling investors. Yahoo Finance Washington correspondent Ben Worskell joining me now with the latest. And of course, not just defense and housing yesterday, but the whole Venezuela situation, the effect on oil and on the energy markets. And, you know, it's kind of kicking off this year a little bit like we kicked off last year with this just forceful comeback of announcements on a variety of industries and the president really firing off a lot of different directives in quick succession.
Absolutely, yeah. You mentioned at the top that one of the big questions of all these pronouncements yesterday is what Trump will do, whether he'll follow through. Venezuela, as you mentioned, is something he is definitely going to have to follow through on one way or another. And the question of oil is top of mind. We have a new interview overnight that the president did with the New York Times, where he gave some new details about his plans there, including plans to stay in Venezuela for years. He was asked about running Venezuela for a year, and he responded, quote, "I would say much longer." Obviously, that is to sort of redo their oil industry, and also comes after plans yesterday from the president announced to control the oil industry themselves. The way he describes it, the details are still being worked out here clearly, is that all the Venezuelan oil would come to the U.S. and be sold by the U.S. with the proceeds being controlled by President Trump himself for the benefit, he says, of Venezuela and the United States. Obviously, this is one aspect of this and it's still being worked out. It's going to be continued over the coming days. Oil executives are set to visit the White House tomorrow for a kind of a wide-ranging summit in person to kind of start to sketch out the plans here for the coming years with all this Venezuelan oil.
Yeah, and we're going to talk more about the Venezuela situation in a few moments with our reporter Jay Conley. The real question there is who pays for all of it, right? Not who buys the oil, but who pays to get the oil out, who pays to refine it. There's a lot of questions still that remain around all of that. And speaking of questions, most of the time, all of these things that happen out of the White House, they then result in more questions, a cascade of questions. So let's talk about some of the other stuff that we heard about yesterday, the defense directives that we got from the White House. On the one hand, some curbs on the defense companies. On the other hand, a lot more spending on defense.
Absolutely. Yeah, there's a bit of mixed messaging here on the defense side. I checked, and two of these posts came literally 15 minutes apart, which were pushing defense stocks in different directions. On the one front, Trump did announce an executive order to ban defense contractors from stock buybacks and issuing dividends. There's actually the text of an executive order that's been issued there. So he's taking action there, which is a kind of a negative for the stock price of these defense companies. On the other hand, he also announced a massive increase that he wants of the defense budget overall from $1 to $1.5 trillion. That's $500 billion additional. A lot of that money, presumably, which would go to these defense contractors. So both of these were happening kind of in rapid succession, and also, of course, comes in the context of whether Trump is looking to use these military assets immediately. The latest indicators there, at least on one front, are a bit de-escalatory. He spoke with the Colombian president last night and said it had a nice tone, and that they're going to be meeting in person soon. So at least a little bit de-escalation on that front, but Trump, the president, is clearly moving forward on defense, getting military readiness top of mind.
And then let's talk about housing. So there is this situation over the past few years where we've had private equity companies or institutional investors buying up individual homes and renting them out. And the president's under the gun, as we know, on affordability. And so he goes out and says, well, you guys can't buy more of these houses. So how much force does that pronouncement have, and what effect does it really have?
Absolutely. Yeah. There's a lot of questions here about sort of how Trump will follow through and how much he actually can follow through. He even acknowledged in his post that he probably needs Congress to act on that. And that's far from a sure thing. I mean, I think his language in the post is important to read here. He described it as a ban on buying more single-family homes, stopping large institutional investors from doing that. That's a sort of relatively limited world here in the overall real estate market. A Brookings study found that large institutional investors only control about 3% of rentals for single-family homes. But obviously the details of this will depend. Will factor in here in sort of how much impact there is. Either way, we obviously saw a lot of impacts in stock prices. Blackstone, as an example, was yo-yoing yesterday as people were starting to digest this announcement.
And then finally, something else that we have to be watching while all this is going on is the perhaps coming tariff ruling from the Supreme Court. It could come as soon as tomorrow, Ben. What's the scuttlebutt in D.C. as to the timing and what we need to be watching?
Absolutely, yeah. So this is the kind of fourth big one on the list, possibly for the next couple of days. What the Supreme Court has announced is that they will convene at 10 a.m. tomorrow, and they may issue opinions. The tariff decision is obviously the top of mind one, and there's a lot of speculation that it could be coming. This is the rough time frame that they've been talking about for a decision there after arguments last November. The case here is about Trump's blanket tariffs. This makes up about half of Trump's tariffs by revenue. It's about 55% of how much money the U.S. brings in from tariff revenue is these IEEPA, the International Emergency Economic Powers Act tariffs that he's really moved on in the last year. What I'm watching for closely, and I think is going to be a big issue to digest for markets, is the nuances of this decision. I think there's a lot of expectation this is going to be a lot different from basically a thumbs up or thumbs down decision. In the arguments last year, the justices were talking about emergency powers. Maybe some are more valid than others. So there could be some level where emergency powers there's a line drawn there. There's also the question of refunds. Everyone from Amy Coney Barrett on down has talked about how that could be a mess. But depending on how the justices rule, that could be also on the table as well. So that'll be depending whenever this decision comes, it's expected the next couple of weeks will be a lot for markets to digest on the trade front.
Whew, Ben, going to be busy soon. Well, you already are busy. You're going to continue to be busy. Thank you so much. Appreciate it.
Whiplash for investors this week as President Trump roils sectors from housing to defense to energy with policy ideas and military action. But my next guest says investors don't need to react to the geopolitical risk in a material way. Join me now. We got Rebecca Patterson, former Bridgewater Associates Chief Investment Strategist. Rebecca, it is great to see you. So President Trump, a lot of headlines there, Rebecca, a lot of social media posts. Affordability, of course, is front and center for the administration now. Maybe start, Rebecca, and there's a range of ways we could go here, but housing, let's start there, because Trump says, you know what we should do? We should ban big institutional investors from buying single-family homes. What do you think, Rebecca? Smart policy?
That's a meh. That's my technical term. There are some analysis out there that suggests that the institutional firms buying up these homes leads to higher rents. At the same time, it can bring down home prices. So the jury's out on whether this is the optimal policy to address the housing affordability crisis. I think there are a lot of other things that can happen. Congress is already looking at a couple different bills. They're going through the process that would do things like speed up permitting for home development or push local and state government officials to have more supply of starter homes. So there's different things that will probably get done that have bipartisan support. So this step by the president makes for a good narrative as he's starting to look at midterms. But I think there are other means to, really handle this that don't require an executive order from the president. In addition to that, though, you need lower mortgage rates. And right now, we're seeing 10-year yields kind of ticking up a little bit. So focusing on fiscal sustainability, frankly, would probably do a lot more to help the housing market than this particular policy idea from the president.
Another area I want your take on, Rebecca, events in Venezuela and what you make of what we're seeing and hearing there. The Trump administration seems to be saying, you know what we're going to get is big oil. Big oil, we can get them back in here into Venezuela, Exxon, Conoco, and they can help really reshape, remake that industry and market. Obviously, it would take a lot of money and a lot of time, but what do you make of that, Rebecca?
Yeah, let's tie that to the affordability crisis. Look, if you can get more global oil supply and supply growth outstrips demand growth, you will have lower prices. And that certainly helps the consumer today. If they have to spend less filling their vehicle, they have more money left over for other things. So lower oil prices, great news for the consumer. It would help bring broader inflation down at the margin, which maybe can help the Federal Reserve cut rates a little more in the future. So all that's good news. The challenge with the oil plan is really time frame and companies' willingness and ability to go to Venezuela and do things quickly. I mean, if you are a large oil company, you care about certainty and the oil price. The lower the oil price, the less cushion you have for a new project to be profitable. And right now, oil prices are relatively low. The other thing is certainty. You want to know who the government's going to be in Venezuela, not just for the next 6 months, but for the next 6 to 10 years. You want to know what U.S. policy is going to be. You want to know that your employees there are going to be safe. So there's a lot that has to get done before I believe you see major oil companies going back there in size. So the possibility of more oil supply coming out of Venezuela is there, but I think it's longer term. It's not going to do anything to address the affordability crisis between now and the midterm election, quite frankly.
All right, so a lot of questions remain. Here's another question. That big jobs report, Rebecca, on deck. We got other economic data today, though. I'm curious what you make of that data. What do you make of just the labor market, where we are, Rebecca, where we're headed, and what that means for the American consumer?
Yeah, so the good news with the labor market is that there is a lot of data to parse, and really you're going to do better predicting what it means for the Fed and the consumer by looking at it holistically. And today we had Challenger and Gray, so that's layoff announcements. We had weekly jobless claims. When I look at all this together and including tomorrow's payroll report, the picture I'm seeing is one where you're not seeing a speeding up of layoffs. That's good news, right? Companies aren't rushing to fire everyone. At the same time, they're not hiring very quickly or picking up hiring either. The Challenger and Gray report today showed a little bit of a pickup in hiring. That's great news. But if you put it together with the whole last quarter, it's still a pretty cautious picture for employers. The bottom line for me here is that the Federal Reserve's last cuts were done in part as insurance to make sure the labor market doesn't deteriorate faster. We're not seeing any data since that December meeting that suggests they need to cut again in January for this reason. I think we're going to have a pause from the Fed in January, and they're going to want to stay data dependent. You know, Scott Bessent today, Treasury Secretary, said they need to keep an open mind. I believe they are. They're looking at all the data, and they're going to let the data help them decide if more rate cuts are needed, how quickly, and how many.
Finally, Rebecca, I do want your take on the stock market. Wall Street seems to be all in, Rebecca. I don't remember the last time I had a strategist on the show who wasn't constructive, who wasn't bullish, but I'm curious to get your thoughts as we start a new year here.
I echo what you're saying. It feels like everyone is on one side of the ship. And look, there is a narrative that's quite reasonable to support that. As we heard today, the tax refunds are going to come soon. They're going to be large. That should support consumer spending for at least a few months. It's possible that job cuts don't get worse, so people have incomes that helps them spend. The Fed may ease again a little bit later this year. That's supportive. So there's a lot to like about the equity market. At the same time, when everyone is on one side of the boat, it pays to think what could go wrong. And we just talked a minute ago about tariffs. You know, tariffs are going to stay, but there's going to be volatility around that. These policy surprises create a level of uncertainty. I think you've seen that reflected in the markets this week. So I personally say, yes, you can stay invested, but make sure you have diversification within your portfolio. Things like global defense stocks, which are not going to trade one for one with AI stocks. Having a little bit of gold in a portfolio through an ETF, a gold miner, what have you, having some short-term fixed income, getting some global diversification as well. So I think you can stay invested. There isn't a reason to think we're going to suddenly have a recession, of course, but you want to make sure you have enough diversification in those assets that you can kind of ride through these policy shocks and continue ideally to compound over time.
Now, last question, Rebecca, I got to ask, since you mentioned those defense names, what did you think of Trump's comments on that sector? Because he doesn't sound too thrilled with some of our defense contractors. Did that make you reconsider maybe your bullishness there?
No. So he's saying two kind of contradictory things right now on defense. On one hand, he doesn't want them to do as many buybacks. He wants to cap executive pay. And you could say, yeah, that could be negative for the stocks, the sector. At the same time, he said he wanted to increase the defense budget by $500 billion, which would obviously be very beneficial for these companies. With executive pay, the government does have leeway to put in stipulations in future government contracts that have to do with executive compensation. So they can affect things going forward in some areas. But the president does not have the ability to just blanket tell companies and sectors what to do. I think more than anything else, he's just trying to show them what he would like to see happen and hope that they fall in line, at least directionally.
All right, Rebecca, always great to see you and to have you on the show. Thank you so much.
Thank you.
Tony, it's always great to see you. So let's kind of start big picture here, Tony, because a lot of headlines from Trump. It's kind of a 1-2 punch. On the one hand, big defense budget increase. That's good news. But then he's cracking down on buybacks. He's going after executive comp. I mean, how as an investor do we make sense of all this? Tony, did you read these headlines on balance? Did you say good news? It's bad news? Walk me through it.
Yeah, great to be with you, Josh. I'd say overall, long term, I'd say this is a strong demand signal. Obviously, in the near term, there's volatility. Obviously, his tweets yesterday regarding executive pay, buyback dividends, those are obviously not, those aren't productive as far as it goes with, the defense industry. But it just shows that I think we need the defense industry primes to, essentially to get these programs on track. And the reality is they're going to need a lot more to restock inventories that have gotten used over the past few years with Ukraine and with Gaza and Israel. So I think you're going to see a lot more of this going forward as far as increase in production. The Lockheed comments that came out the day before, increasing, tripling production of the PAC-3 missile. Probably going to see more announcements in the near future.
Well, it is interesting, Tony, because when you read that post from Trump on social media, what he seems to be going after them for in part is like, listen, he says, you're moving too slowly. And I just wonder, as someone who knows the industry, I mean, is that a fair criticism, Tony? And if that's true, what's the reason? What's the choke point? Is it labor, supply chain? What's going on?
Yeah, I think there's always two sides of the story, and I think both sides, it's probably not a great answer, but both sides have a point. I think on one end of the spectrum, you have the defense industry that, making these very sophisticated, technical weapons that have huge supply chains. And then you have the labor side, which is, again, highly technical. And on top of that, which is unusual compared to the rest of maybe its peers, industrial peers, they have to have a security clearance on most of these weapon systems. And if you haven't ever been through a security clearance process, you'll quickly realize once you do how long it takes. And again, it's like fine wine or whiskey. You can't speed up the aging process, and it just takes time. And that's been an issue, since the defense industry has really formulated, and you've seen it, particularly on the Air Force One program, amongst others. And I think that's going to continue. And then the other side of it, of course, these are oligopolies. These are very consolidated industries, and a lot of them are sole source. So they hold a lot of, they carry a lot of weight. But, then again, at the same time, it's a monopoly where you have one customer, and that's very unusual, I'd say, in a sector or an industry. And these guys want to keep their one customer very happy and, a follow-up and improve. So I think you probably have a little bit of both in each side, and all things being equal, the demand's there, the know-how is there. And I think in the long term, they're gonna get this figured out, including Raytheon, which is one of our large positions in our the military killer space and defense, EPF, ticker GCAD. amongst other primes and, tier one, tier two suppliers. And they're going to, I think, benefit from this in the long term.
Let's end here with some places where you do see opportunity, Tony. Why is Albany International a buy? I mean, it's down about, it looks like 30% over the past year. How come that's a smart place to commit capital?
Yeah, our Albany is one of our largest positions. We see that as essentially a sum of the parts story. They've got two businesses, a business which is nothing related to aerospace and defense. It's called a machine clothing, which they actually make the belts that make paper and pulp products. And it's a great business, but it's not a lot of growth, relatively high margin. And if you take that business alone and essentially net out the net debt, essentially that's the market cap of the company right there. And then you essentially get the aerospace business, which they use the technology from this machine clothing, these belts that they've learned to produce at a very effectively, and they use this thing called 3D weave, carbon fiber weave, and they're able to make fan blades for commercial planes, and they have a large contract with Safran to supply fan blades for the 737 MAX, the LEAP engine, and the Airbus 320. That's a huge backlog, huge contract, very profitable and long legs on it. So you have these two businesses. It's probably a subscale on each one, and I think eventually they're going to get these programs in line. They've got some other things that are going on as far as defense contracts. They'll probably be able to fix those, and I see it as it's probably going to be a double or more in the long run on a sum of parts basis.
Tony, always great to have you on the show. Thank you, sir.
Well, let's get back to the productivity discussion, because we saw U.S. labor productivity accelerating in the third quarter. This was numbers that we got yesterday to the strongest pace in 2 years, 4.9% on an annualized basis. That was according to data from the Bureau of Labor Statistics. Still with me, Joe Brusuelas, RSM chief economist, Steve Sosnick, Interactive Brokers chief strategist, and Leslie Falconio, UBS Global Wealth Management head of taxable fixed income strategy. So that number on productivity, we were just sort of talking about productivity a little bit and why we saw that big increase in productivity. Joe, what happened there?
Well, we're producing a lot more with a lot less people. This is at the end of the day. Look, the productivity boom started in 2023. By the way, great data viz, everybody back there in the production room as we went to break. I really loved that. It looked great.
Aww.
And what's happening is a couple of things. Total factor of productivity, which the economist, they will go right to that to say, hey, if that's increasing, I think it was up 12 of the 21 major industries saw an increase in TFP through the middle of the year last year. So there's a good thing happening here, right? And we don't want to lose that amongst all that other noise in the news right now. However, some of this undoubtedly has to do with the fact that labor hoarding, which had been with us since the pandemic, has come to an end, and big corporations are right-sizing. That's one of the reasons why we're seeing these very, very modest increases on a monthly basis, because they've integrated some very sophisticated technology into the production of goods and the provision of services. Don't think of it as AI, think of it more as machine learning. Now, the AI boom, the productivity boom that we all talk about here on Wall Street, that's still a couple years away, right? It's going to happen. But we're beginning to say, look, we've put so much money on the table. What are we getting on our return for investment? Where do we need to deploy the newer technology, right? How can it help me make my firm more efficient and more productive? And this is going to be one of the big issues, because we're going to grow pretty strong this first half of the year. I'm thinking about 3%, but our forecast was 50,000 a month for the entire year. Well, Steve and I aren't going to have any problem with that, because earnings are going to be good, profits are going to be better, the economy is going to grow. It's a bit difficult to explain to the public. Once I get outside New York, I go west of the Hudson, people get a bit pissy when I talk about 50,000. Well, what do you mean? Well, what it means is this is all we're going to grow. You're all employed. Your wages are going to improve, but it's going to be more difficult finding a job. Inside that data this morning, the median duration of unemployment went straight up. And compared to where we were last year, people working part-time for economic reasons has increased by 980,000. So we're more productive, but if you want a new job, it's going to be a bit challenging.
Well, and Leslie, to come back to you on this, we were just talking about some of the measures, the early measures that we're seeing this administration try to put in place on the affordability front. I mean, as an investor at this point, do you have to try to then maybe theorize to some extent about what may be coming down the pike on that front and get ahead of it?
No, I think so. I mean, I do agree, or I do believe that, as we just talked about earlier, this is more of the appetizer when it comes to GSEs buying, because again, you'll have the mortgage rate might decline on that somewhat, but depending on what the 10-year Treasury yield does, but it's not going to get to the level where it's going to, influence affordability materially. I mean, in order to really do that, unfortunately, you have to be more on the supply side, in my opinion. There's demand side things that can be done. Maybe in Davos they announced some sort of reignite of the Operation Twist or something that bring down that 10-year Treasury yield. But otherwise, a Fed cutting once or twice is just simply not going to do it. And, I do agree, when we talk about this productivity, the number of 4.9%, obviously it can be very volatile. But even when you look at the, 10-year average, it's running about 2%. But this sort of no higher kind of environment, I do think is going to be an issue down the road. And when the Fed cuts once or twice, you're not really doing anything to help that part of the equation. It might be great for small businesses, it might help a little bit in terms of someone's car loan, but it's not going to be enough of a push where you really influence the K-shaped economy. Or do we think it's going to really, this recent measure, going to heavily influence the affordability issue? So I do believe there's going to be much more down the line. But again, there's things that they have to be considered. Like if you give tax incentives, you got to go through Congress. You have to look at the deficit. I mean, there's a lot of obstacles to go through before we can really address this issue.
Yeah. I don't know. I want to glibly say deficit, schmeficit. Nobody seems to care about that in DC anymore, but that's a discussion for another day. Steve, but this does bring me to the idea that we continue to have this strange disconnect, right, where the vibes are bad, as we know, on Main Street. Markets continue to go up. Companies continue to mint more profits. From an investment standpoint, are there implications of this, or can this kind of continue indefinitely?
It can continue for quite a while as long as the vibes remain okay. Part of it is, both Joe and Leslie referred to the K-shaped economy. I'm going to assert, I think we've gone from a small K to a capital K, and we may have actually an inverse small K, but the thing here is investors live at the top half of the K, and we can debate the social aspects of that, but bottom line is that's what it is. So as long as investors feel okay with all this, this is going to continue. Individual investors also feel even more more emboldened by the stock market, and also more tied to it. I think a lot among younger investors, a lot of them are sort of, I've seen the term financial nihilism. I've used the term nihilist market before, but I've never used it, but someone else came up with the other term. And I like this idea because they sort of figure, it's how am I going to afford a house? How am I going to afford the lifestyle that I grew up with? And maybe the stock market, maybe crypto, maybe prediction markets is the way out.
Well, on that housing affordability issue, right, and the proposal of $200 billion in mortgage-backed security purchases, between 2020 and 2022, the Fed purchased $1.3 trillion out of the $1.5 trillion, and 90%. $200 billion is not really going to move the needle much. It's going to account for basically a 25 bips rate cut. That's it. When it comes to housing affordability, we don't have a financing problem in this country. We have a supply issue.
Right. Leslie was talking
about
that.
And this is really critical, because if you alter the mechanisms of finance to force rates down, what happens is people come back in the market and they bid the prices up because we got insufficient supply. What got buried here today is that housing starts number, 1.246 million at an annualized pace. I'm sorry, that's a big deficit. We need to be doing 2 million at an annualized pace, and we're really short housing here. So those proposals actually may be counterproductive.
The real estate market is potentially facing a major shakeup. Just last month, President Donald Trump said he was planning to unveil some of the most aggressive housing reform plans in American history. Fast forward to the new year, and the president is finally sharing more insight into his plans to address housing affordability. Trump saying in a social media post that he is taking steps to ban large institutional investors from buying more single-family homes, and will be calling on Congress to codify it. Shares of Blackstone sliding on this potential ban for institutional investors. The asset management giant, which manages more than $1 trillion, has spent the last few years building one of the largest rental housing portfolios in the country. This trend in housing reached a new high last year when a record 30% of single-family home purchases in the first half of 2025 were made by investors. That's according to analytics firm Cotality. Trump is expected to discuss the topic further, along with other housing and affordability-related proposals, at his upcoming speech at the Davos conference near the end of this month.
I do want to start with the Affordable Care Act because it ain't dead yet, I guess, in terms of that extension. There's still some reports lingering this morning that Senate Republicans might be making progress on some kind of compromise. I mean, what do you think the chances are at this point?
Hey, Julie, thanks for having me again. Yeah, I mean, this is the issue that won't die. We started writing about it in July. I think it was a Halloween of 2023, and here we still are having the conversation. So look, what the reports show is that there are some Republicans who have been the ones saying they want a deal for months, saying they feel like they're close to a deal, but what we've seen from Democrats is they don't think they are. There's a big battle over abortion language that's still in place, but even some of the core things that Republican Senator Moreno has said from Ohio about minimum monthly payments is something that very senior Democrat Wyden has said no to initially and pushed back on. So I continue to think the odds are less than 20% we see any type of a deal. We're now past the deadline. People understand where things are, but also from signups at the same point last year where we had 16 million people late in December, we're now at 15.6. So we haven't seen a huge drop off initially of people signing up for coverage, despite the fact many are going to have to pay more.
Gotcha. What about some other sort of policy insurance changes coming down the pike this year? I know you're watching Medicare Advantage, for example, and any kind of rate changes there.
Yeah, we're excited. We think Medicare Advantage is a really positive place to be. There's been a lot of rhetoric in 2025 about what could come from it. But when you look at what really happened, they had a positive rate update. They had $13 billion more in STARS funding coming their way. They allowed voluntary agreements from the insurers on prior authorization instead of regulating it. We think you're going to get a positive rate update the first quarter of 26. And then we have to watch as we get into November if they make some changes. But the administration doesn't want to cut Medicare, in our view, before the midterm elections.
Gotcha. In terms of policy changes, there's something else on my mind that I want to ask you about, Chris, and that is the new food pyramid getting a lot of attention. Some in the nutrition community saying this is not a bad update. They have maybe some reservations, but I'm curious, when you see a food pyramid change like this, what effect does it have in reality on, on the food system, on the healthcare system? Like what force does this thing have?
Well, let me start by saying they're going to have to claw my Coca-Cola from my cold, dead hands at some point in the future. But in the near term, I mean, what they're trying to say is, look, they want more protein, less added sugar, more natural food types. But they're not going to ban these types of activities. They're saying there are appropriate types of fat and good fats that are positive. They removed the alcohol. 1 drink for a woman a day, 2 drinks for men a day, and saying just to drink less alcohol. But generally speaking, these changes are more recommendations than binding. They can impact areas like menu rules and procurement guidelines, around school meals, WIC, SNAP, Head Start, some DOD funding, food programs as we go. But overall, these are new recommendations, and I'll let someone who's more qualified than I am, maybe a healthier eater than I am, make judgments on whether or not they're good or bad.
You got to give up that Coca-Cola, Chris. Come on, that added sugar can't be good for you, but that's okay. It keeps you going, gives you energy to talk to me. So
exactly. Without that, I wouldn't have been here this morning.
Okay. Well, then keep that Coca-Cola coming. I want to ask you, I guess, more broadly about, the new HHS and the various agencies underneath it, and whether thus far, for the healthcare industry at least, this RFK Jr. leadership has been as problematic as maybe anticipated. I mean, we know for some of those vaccine changes, those recommendations have been troubling to some in the medical community.
Yeah, the vaccine changes are obviously the most consequential, I think, largely speaking, of the changes we've seen. And there are real concerns about childhood vaccination rate and what the impact of that could be. And the CDC officials that are experts in this were largely bypassed for those decisions. So we just have to acknowledge that. However, when we look at most other areas of healthcare, what we've seen is a lot of rhetoric that sounds bad for industry. But when you look at what they've actually done, it's been more bark than bite. When we look at the pharmaceutical industry, they talked a big game on going after the industry, but the industry, got around tariffs. The MFN isn't consequential. There's a reason Pfizer was up the day the deal was announced. We look at the trade agreements. The UK, they're just going to pay more for pharma, which is good for the industry as we go. The biggest issues for pharma are really uncertainty at FDA, and they have right to be concerned about that, from the staff cuts as well as the somewhat manic nature of decision making over there, and to some degree crony capitalism that's happening. I think when you look at the insurers and healthcare, largely speaking, yes, Congress has passed big changes with $1 trillion in cuts to Medicaid over a decade, but those haven't gone into effect yet. MA, you've seen a really positive environment. So there's been a lot of rhetoric, but the reality overall has been favorable for industry. And I think that's why, if you look at how healthcare performed X the Mag 7, it actually outperformed the S&P last year. If you take United Healthcare out of the agenda and some of the managed care companies, healthcare, largely speaking, the subsectors had a really good year in 2025, and I think that's underappreciated.
Yeah, and some of those big drug makers in particular, which was a surprise. To your point, there was all that rhetoric about coming down on drug pricing, and then some of these drug makers struck deals with the administration, and it's stuff that didn't necessarily negatively affect their revenue. I'm also curious on the regulatory approval process for some of these things. Like, we're waiting, for example, for the new Eli Lilly oral obesity medication to be approved. What do you think that timeline is going to be like for that one, and in general for the FDA?
Yeah, it was sooner than we thought for Novo's drug. So that was fascinating to watch how quickly they did it, and where they are with that. I think they are looking to move quickly on the Eli Lilly drug. So sooner rather than later, exact timing to be determined. But what I will think is interesting, and Lilly's a great example of this, in an environment where you have products that we're going to go head to head and compete on price, yes, the agreement with the companies, Novo and Lilly, from the White House, theoretically lowered prices from what they are today, but it probably created an artificial floor that was higher than what competition would have led to had they not created this minimum payment that they agreed for these products. So it actually ended up probably being a win for the companies on a whole, as they look in the out years, making this deal with the White House compared to what the market would have allowed.
And Chris, one other sector I want to ask you about, or subsector I want to ask you about, are the pharmacy benefit managers, which has really been under fire in Washington. And, if you talk to them directly, they'll say, well, we help keep prices lower. We help negotiate prices for large groups, including employers, for example. Are they getting much of an audience for that argument in D.C.?
They are the favorite whipping boy of everyone at this point, it seems. They continue to be in the headlines. They're going to continue to get whacked. Pharmaceutical industry goes after them, and everyone else just doesn't want to be targeted. So they're piling on at this point. I think we do have to at least acknowledge the fact that there's only one government health program that I can remember that's ever come in under budget, and that was Medicare Part D when it was designed. And the reason for that is they negotiated much lower net drug prices than the government thought they would be able to. And that's a credit to the PBMs. Now, is it possible some of the business practices are resulting in artificially increasing the list prices of drugs? No question about that as well. But does there need to be a negotiation, I think, is something people are open to. With that being said, if Congress is able to do something bipartisan on healthcare, which is a big if, capital IF for if, PBM language will be included, but the result of that probably will be to the benefit of the big three and push everyone who's not the big three, 80% market share, out of business. So the big three probably get bigger because the ones that are doing these things that people dislike the most about retaining rebates are really the smaller players that don't have the purchasing power to get the best prices for these pharmaceuticals.
Interesting. And for people watching, the big three are what? UNH, CVS?
Yeah. And Cigna.
And Cigna. Gotcha. Okay.
You got it.
we'll know what to watch beyond that then. Chris Meekins of Raymond James, Happy New Year. Great to see you. Thank you.
Happy New Year. Have a good one. Thanks, Julie.
Investors shaking off concerns about geopolitical risks from the U.S. intervention in Venezuela. The bullish sentiment boosted by greater confidence in fiscal discipline in some of these markets and more money shifting away from the U.S. Let's talk more about this. Joining me now, Ben Mandel, Jabarte Capital Head of Research, and Derek Irwin, Allspring Global Investments Senior Portfolio Manager and Co-Head of the Intrinsic Emerging Markets Equity Team. Guys, thanks for being here. It has been obviously an understatement. An interesting week thus far, an interesting weekend into an interesting week in emerging markets, particularly with Venezuela. So I do want to broaden it out to emerging markets, but first we got to talk about what happened and what it means for Latin American markets, if anything. Ben, I'll start with you on that. You're actually based in Brazil, so you're based in Latin America. So how are you thinking about any potential spillover effects, or do you think it's going to be fairly limited?
Thanks, Julie. Good morning. Well, there are global effects and there are regional effects. So I think let's start with the regional ones. The action in Venezuela has put LATAM in sharp focus for the first time in decades. And you can draw a line between what happened in Venezuela in January, the Trump national security strategy released in December, the bailout of Argentina in October. And that illustrates a paradigm which has very well-defined winners and losers at the country level. And so from a LATAM investor's perspective, that's exactly the right framing. Thinking about highly idiosyncratic, country-specific effects coming from the evolution of U.S. international policy. As you mentioned, I'm based in Brazil. Brazil is an excellent example of a country where the spillovers are generally positive. It's a geopolitically neutral economy. That is to say, it transacts with a lot of countries, but is not dominated by any of them. It's a net winner in the trade war. All of the trade diversion that's coming from China and the U.S. to Brazil, and soybeans is a great example of that. It has a lot to offer in terms of natural resources and critical minerals in particular to a Trump administration that's looking to make deals. And it has a pretty good cyclical starting point. So interest rates are generally high. Inflation has been coming down. And so the starting point makes sense to get in. And so that is to say, it's not all bad news in thinking about, who will be affected by the action in Venezuela specifically, but also the spillovers and potential follow-up actions in other Latin American countries. There are also winners, and we classify Brazil as one of the key winners here.
Interesting, and also interesting the idea that this draws attention to the area, even, and then hopefully benefits maybe some of the markets that are attractive investments there. Derek, what about you? How are you thinking about Venezuela through the lens of emerging market stocks and what the implications could be?
Yeah, I think if we look at emerging markets more broadly, but certainly Latin America, the way I look at Venezuela is geopolitically, obviously incredibly important. From a market moving or economic standpoint, obviously not as important, at least in terms of first order effects. But I really like the concept of bringing attention to what is already a very positive story in Latin America. And we're overweight the region. We have been coming into the year and certainly coming into this event for exactly those reasons. We think the markets are inexpensive. They're largely ignored by a lot of investors after several years of underperformance, and the macroeconomic setup is pretty good. So I think that to the extent that there are geopolitical ramifications or second order events, it probably is largely positive for Latin America in the sense that, ironically, the action in Venezuela may bring some stability. And it may also give a tailwind to some of the more market-friendly candidates in this year's elections. We have some big elections coming up, obviously Brazil, Colombia, Peru, over the next year. And we think that the influence of the U.S. and the influence of some of these actions could be a tailwind to some of the more market-friendly candidates. I think the interesting question will be, do we see further reverberations beyond Latin America into certainly Asia and China, and even into the Middle East? And I think there's room to be to look for real opportunities there in the wake of this.
Well, Derek, something I want to follow on that I'm curious about, because certainly the President Trump has mentioned some of some other countries that have, been under his scrutiny. Colombia, as you mentioned, is one of them. And while the situation in Venezuela hasn't had spillover, I wonder if there are other incursions, if the risks would be potentially greater than the potential market benefits.
I think it's really hard to say. I mean, Colombia, you're absolutely right. I think Trump has made some comments there. Even Greenland, who knows? He's made some interesting comments in, farther afield, of course, in Iran. And there's a government that is right now looking quite shaky. So it would be very interesting to see two very large oil states potentially fall or change leadership over the next year. Although I think it would be very unlikely that the U.S. would try to do something like we saw in Venezuela and Iran. And then, of course, we do need to think about Cuba. Obviously, from an investment standpoint, not as important, but geopolitically, I think that would send a very, very important message to the rest of the world. So it becomes a politically really exciting time. And for investors like us, often that creates dislocations in the market that we can take advantage of.
Okay, so let's take a step back then, and as we talked about, broaden it out to more sort of emerging markets in Latin America and beyond. Ben, this year, I'm still used to saying this year, in 2025, we saw outperformance of international stocks versus US stocks. Does that continue in 2026, and in particular, do we see outperformance of emerging market stocks?
I think there's broad opportunity thinking about emerging markets as a whole, so EM writ large. Global markets tend to prefer indirect conflict to direct conflict. And so this pivot towards the Americas that we've seen from the Trump administration is not out of nowhere. It's a function of its lived experience in 2025. Despite appearances, there are real limits to Trumponomics and Trump's international policies. And the most striking of those limits was shown by China and its critical minerals export restrictions, effectively saying that leveraging U.S. bargaining power to extract concessions from our trading partners can only go so far. It cannot continue ad infinitum. And so the pivot to Latin America through that lens makes total sense. Venezuela as an important trading partner with China, with Russia, with Iran, and markets generally like that indirect conflict, or at least prefer it to direct confrontation with China. The negative spillovers to U.S. growth are lower, and it's generally a recipe for risk sentiment to be a little bit more buoyant, which are the conditions, kind of the necessary conditions for EM markets to outperform. And so we see a lot of scope for that to continue in 2026.
Yeah, we'll see if the conflicts do remain less direct, so to speak. Derek, I know that you're bullish on emerging markets in 2026 as well. Are there any specific ones that you think have the most room for upside?
Look, I think there's probably three big drivers for the market in 2025 that can drive upside. Certainly, I think the AI trade has legs. And I think you had a great segment before this at the CES that really talked about some of the opportunities in memory and computing chips. And of course, companies like TSMC and Samsung and SK Hynix in emerging markets really sit at the center of that, and they should continue to benefit. In addition, China, of course, has a very strong AI ecosystem that in many ways is developing in parallel to that of the West and is equally interesting and maybe underexplored by a lot of investors. So there's really two AI drivers in EM. Beyond that, of course, we do think some of the drivers that will buoy Latin America in terms of lower inflation, potentially lower interest rates, will also help a lot of other emerging markets, like, for instance, South Africa, which is seeing significant government reform, significant fall in inflation, and should see rates come down, which should boost the consumer. So I think that's great. And the third message we have for investors who may be looking at emerging markets for the first time in some time is that it's very likely, in our view, that the relative risk of investing in emerging markets versus, say, developed markets is much less than they might have thought. I think emerging markets have generally been considered the sort of very risky tail on the investing asset allocation dog. And I'm not sure that's the case anymore. I think over the last 10 years, emerging markets have generally become a less risky place to park capital, and arguably developed markets have become more risky. So I think there's a lot of reasons for investors who are looking to dip their toes back into emerging markets to be comfortable doing so.
Really interesting stuff, guys. Thank you both so much. Appreciate it.
Thank you.
Thank you.
Over the weekend, Venezuelan President Nicolas Maduro and his wife were captured by U.S. forces in a surprise military operation. Now, many questions remain over the future of the oil-rich nation. President Trump has said the U.S. is now in charge of Venezuela. And this morning, Maduro appeared in federal court in Lower Manhattan to face U.S. drug trafficking charges. For more on the market reaction, the stocks to watch, and what happens next, we're joined by Yahoo Finance's Ben Worschkel, Inez Ferre, and Jake Conley. Ben, let's start with you and the view from D.C. here, because yes, President Trump has said we're in charge, but we've gotten some mixed messaging, and I assume there's going to be a lot of confusion in the coming days.
For sure. Mixed messaging is a nice way to put sort of the back and forth here over this weekend about exactly kind of what policy changes are in the offing in Venezuela as a result of this. As you mentioned at the top, Trump has said that the U.S. is now running the country, but it is worth noting that the acting president of the country right now is a woman named Delcy Rodriguez, who was the vice president last Friday to Nicolas Maduro and is a longtime ally and a longtime socialist as well. So she offered a statement last night that offered sort of conciliatory language towards the U.S., talked about a cooperation agenda around shared development between the U.S. and Venezuela, but exactly what that means isn't clear, and how her new administration begins to work with Trump and his team very much up in the air, especially on this oil front. I think this sort of shared development is clearly a kind of a code for oil, but exactly what that means for the U.S., for all the other countries involved in Venezuelan oil, it remains to be seen. You mentioned the kind of muted effects of this so far on oil markets and equities. I think the way this changes is on this oil front, especially with China. That's the sort of area I've been focused on this morning. Venezuela has been described as China's biggest ally in Latin America, a big consumer of Venezuelan oil. Chinese companies are involved in developing oil fields in Venezuela right now. There was a big one last year that talked about a 20-year deal between the U.S. and a Chinese firm. So that, I think, is the major front. So far, the Chinese have just offered condemnation of what Trump did over the weekend, but haven't threatened specific responses. But even Trump acknowledged last night China has a lot of levers to pull. So I think that's a big strand to watch in the days ahead.
And Ben, there's also a lot of course, international reaction here to what has happened, and a lot of speculation about whether this will enable or conversely put curbs on other leaders internationally making these kinds of moves.
Yeah, absolutely. I think one of the other major changes that could be happening is sort of whether Trump feels empowered by this, and we'll see a lot of that in the days ahead to do more of this. Just in the last couple of days, he's talked in similar terms about Colombia, the nation of Colombia. He's talked about Greenland, and he's talked about Cuba, all three areas that he might look to do something similar in the days ahead or days or weeks ahead, depending on kind of the outcome here in Venezuela. I think the initial reaction of Venezuela clearly shows us that maybe the economic effects could be muted. Those are a lot more complicated situations that could be a lot more complex, depending whether the markets tends to start to believe Trump may actually follow through on a lot of these new threats he's making.